Ever wondered how to reduce your taxable income through Schedule C tax deductions? Well, let's unravel the mystery together. Schedule C, also known as Form 1040, Schedule C, Profit or Loss from Business, is a tax form used by sole proprietors, independent contractors, and single-member LLCs to report income or loss from a business or profession. If you're self-employed, you're likely using Schedule C to report your earnings and expenses. The form is filled out yearly and submitted to the Internal Revenue Service, the IRS, along with your personal income tax return. Now, why should you care about Schedule C and its deductions? Well, it's simple. Schedule C tax deductions are expenses that you can write off against your business income. This means you can reduce your taxable income, potentially saving you a decent chunk of change when tax time rolls around. Let's illustrate this with a simple example. Suppose you're a freelance graphic designer and you've earned $60,000 this year, but you've also spent $10,000 on business-related expenses like software subscriptions, office supplies, and advertising. These are all valid Schedule C deductions. By reporting these expenses on Schedule C, your taxable income drops from $60,000 to $50,000. That's a $10,000 reduction, and it could significantly lower your tax bill. But remember, not all expenses can be deducted. The IRS sets specific rules about what counts as a business expense. Generally, the expense must be both ordinary and necessary for your type of business. An ordinary expense is one that is common and accepted in your trade or business, while a necessary expense is one that is helpful and appropriate for your business. Understanding Schedule C tax deductions is not just about saving money. It's also about being compliant with tax laws and avoiding potential penalties from the IRS. So, it's important to get it right. Now that we understand what Schedule C is, let's delve into the specific steps on how to use it. The first step to using Schedule C tax deductions is identifying which deductions you're eligible for. So, let's dive right in. A common deduction for many taxpayers is home office expenses. If you use part of your home regularly and exclusively for your business, you may be eligible to claim a portion of your housing costs. This could include a portion of your rent or mortgage, utilities, and even home repairs. Then we have vehicle expenses. If you use your car for business purposes, you may be able to deduct a part of your vehicle costs. This could include gas, maintenance, and depreciation. But remember, the key here is that the car must be used for business. A trip to the grocery store doesn't count, unless you're picking up supplies for your business. Speaking of supplies, they also fall under eligible deductions. If you've purchased equipment, software, or even office supplies for your business, these can be deducted. Just make sure to keep your receipts as proof of your expenses. Finally, let's talk about depreciation. If you've bought property for your business, like a computer or a car, you can't deduct the entire cost in the year you bought it. Instead, you can depreciate it, which means you deduct a part of the cost each year over the property's useful life. Now you might be wondering, what's the catch? Well, the criteria for eligibility for these deductions is that they must be both ordinary and necessary for your business. An ordinary expense is one that is common and accepted in your trade or business. A necessary expense is one that is helpful and appropriate for your business. An expense does not have to be indispensable to be considered necessary. Remember, it's crucial to only claim deductions you are eligible for to avoid any potential issues with the IRS. So keep accurate records, know what you're eligible for, and when in doubt, consult with a tax professional. Once you've identified your eligible deductions, the next step is to properly document these expenses. Now let's delve deeper into the world of expense documentation. You see, keeping track of your business expenses isn't just about finding ways to cut your tax bill. It's about creating a clear financial picture of your business. Think of it like a diary of your business's financial health. Every receipt, every invoice, every financial transaction, they all tell a story about how your business is doing. So, how do you go about this? Start by keeping records of all your expenses. And when I say all, I mean all. From the big-ticket items like purchasing equipment or inventory, to the seemingly insignificant ones like a cup of coffee with a client. Every dollar counts when it comes to your business's bottom line. Next, make sure to keep your personal and business expenses separate. It's easy to mix them up, especially if you're a sole proprietor. But doing so can lead to confusion and potential problems down the line. Plus, it makes it much easier to identify eligible deductions when your business expenses are clearly delineated. You might wonder, but how long should I keep these records? Well, the IRS recommends keeping them for at least 3 years from the date you filed the original return. And if you file a claim for a credit or refund, keep your records for 2 years from the date you paid the tax. So, in essence, it's always a good idea to keep your records longer than you think you might need them. And finally, consider using a digital tool or app to track your expenses. There are plenty out there that can help you categorize, track, and even photograph receipts for easy documentation. In the end, remember this: proper documentation not only makes filing taxes easier, but it also provides a safety net in case of an audit. Because in the world of taxes, it's always better to be safe than sorry. With all our deductions identified and documented, we can now move on to filling out Schedule C. The first step in filling out Schedule C is to provide your name and social security number at the top of the form. This is standard procedure for any tax form, and it's how the IRS tracks your filing. Next, we delve into Part 1, which is all about your income. Here you'll need to report your gross receipts or sales, returns and allowances, and the cost of goods sold. Once you've input these figures, you'll subtract them from one another to find your gross income. Now let's move on to Part 2, where we get to put our deductions to work. This section is broken down into categories such as advertising, car and truck expenses, commissions and fees, and so on. Each line corresponds to a specific type of expense, and this is where you'll input the totals of your documented deductions. For example, if you documented $5,000 in advertising expenses over the year, you'll write $5,000 on the line for advertising. Continue this process for each category of expense you've documented. Once you've filled out all the lines in this section, you'll add them up to find your total deductions. Next up is Part 3, which is all about calculating your net profit or loss. Here, you'll subtract your total deductions from your gross income. If the number you get is positive, that's your net profit. If it's negative, you've incurred a net loss. And finally we come to Part 4 and V, which you'll only need to fill out if you have a home office or use your car for your business. These sections are all about calculating your vehicle and home office deductions. Filling out Schedule C may seem daunting, but with all your deductions properly documented, it becomes a straightforward process. The final step in the Schedule C tax deduction process is submitting your completed form. Yes, we've made it this far, and now it's time to cross the finish line. So, how do you go about submitting Schedule C? Well, you've got 2 options. The first is electronic submission, which is the quicker and more convenient of the 2. Many taxpayers prefer this method because it's fast, efficient, and reduces the risk of errors. You can use an IRS-approved tax software to fill out and submit your Schedule C. These software programs are designed to guide you through the process, making it as straightforward as possible. The second option is to mail your completed Schedule C to the IRS. If you choose this method, make sure to send it to the correct IRS address for your state. You can find this information on the IRS website. And remember, if you're mailing your form, it's a good idea to send it via certified mail. This provides you with a receipt and assurance that your form has reached its destination. Now let's talk about deadlines. The deadline for submitting Schedule C is usually April 15th. This is the same date as the deadline for filing your individual income tax return. However, if April 15th falls on a weekend or a holiday, the deadline is extended to the next business day. But why is it important to submit on time? Well, late submissions can result in penalties. These can range from interest charges on the amount you owe to late filing penalties, which can be quite hefty. So it's always best to submit your Schedule C on or before the deadline. Submitting your Schedule C concludes the tax deduction process. But remember, this is an annual task for most taxpayers. So, while it's a relief to have it done for this year, remember to keep good records and start preparing for next year. After all, staying organized and prepared is the key to a stress-free tax season. If you need some assistance, contact me, George Bauer, CPA at www.baueraccounting.com or george@baueradvice.com. We've covered a lot today, so let's recap the key points about Schedule C tax deductions. We began our journey with a comprehensive introduction to Schedule C tax deductions. We discovered that these deductions are a way for self-employed individuals and businesses to reduce their taxable income. They provide an opportunity to claim expenses related to running a business, thus allowing you to keep more of your hard-earned money. Next, we delved into the process of identifying eligible deductions. From office supplies and advertising costs to travel expenses and home office deductions, we highlighted a range of expenses that can be claimed on Schedule C. Remember, the key here is relevance to your business. So, always ask yourself, is this expense necessary and ordinary for my line of work? Moving on, we explored the crucial step of documenting your expenses. This is where we emphasize the importance of keeping meticulous records. Receipts, invoices, and mileage logs are your best friends in this journey. They not only make the process of filling out Schedule C smoother but also serve as your defense in case of an audit. We then walked through the process of filling out Schedule C itself. We learned how to categorize expenses, calculate the cost of goods sold, and determine our net profit or loss. This step might seem daunting at first, but with proper documentation and a little patience it becomes manageable. Finally, we discussed submitting Schedule C. We reminded you that this form is part of your annual tax return and must be submitted to the IRS. We also pointed out that while you can do this process on your own, seeking help from a tax professional can be beneficial, especially if your business has complex finances. Understanding and effectively using Schedule C tax deductions can make a significant difference in your taxable income. So, take the time to familiarize yourself with this process and consult with a tax professional if needed.